Your study guide will help you. Then you will know already, roughly. So next Thursday, we will do our ungraded module 2 quiz first. And then the replacement we talk later when more people like turn up because raining, right? Okay. So we will do event after reporting period first. With so module 2, a lot of readings as well, as you know, quite a lot of concepts to study and so on. Alright, so we assume that we have already completed IAS 8, some theory that you have to like, read, relook and so on. So now we are going to look at the next one, part A as well, which is IAS 10. Events after reporting period. We start now. Okay, now it is actually very simple. You just have to understand the key behind this standard. This is an older standard, by the way. Now you see events after reporting period, right? Now accountants English not very good. After, actually it's not after, it's in between. Because some students will ask, after means, let's say if your reporting period is 30th of June, after means 1st of July onwards, right? So I will just say, okay lah, our English is not as good. So our event after reporting period is actually in between the last day of your financial year until the authorization date of the financial report. That's called event after reporting period. Okay? So if you look at the word itself, event, something happened after that, right? So if that thing is not happening after that, it's happening before that, then it is not under IAS 10 already lah. So if you look at this timeline, right? Okay, if you look at this timeline, so let's say our reporting period, our financial year end on 30th of June. Okay, and then the company's accountant will wrap up, do all the adjusting entries and all that after that lah, because after that only we'll receive the bank statement or some of the things during that month. You will have to do adjustment, then you do adjustment for depreciation or whatever. So by the time they finish everything, maybe it's somewhere around here already. So in Malaysia, we are a bit slow. So for June financial year end, normally the company will call the auditor to come in to do audit only in September or even November or even December. We don't really have timeliness qualitative characteristic. So we assume that we are very effective, so we ask the auditor to come in and do audit somewhere around here. So the auditors will take some time to do audit and check everything is okay and so on, whether there's any substantial or material misstatement or not. And then after that, they will try to draft the audit report. And then after that, the audit report will go through the review and all that. And then after that, the report will be authorized. Now, so we are looking at authorization date whereby the board of directors sign off the financial report. Okay, so it is quite effective. Then it is 30th of September lah. So normally we will do like last minute and we use up our grace period given by the Malaysian authorities until like January. So now, if there is an event happen in between the last day of the financial year, 30th of June in this story, until 30th of September, the authorization date, okay, if there's one event, at least one event happen, then we will use IAS 10 as a guideline to do something, okay, to do or not to do, okay, to do accounting entries or to disclose it without adjusting it. Now, therefore, if there's one event happen here, maybe in October, November or 2nd of October, okay, on fire, or the share price drop, or one of the customer who owe this company money bankrupt already. Are we going to do anything? Answer is no. We will not use IAS 10 events after reporting period. You study a little bit in audit already, but I'm not sure how much you study. Okay, so if you study a bit different in your audit class, then you forget about it. So what we will do is, anything happen in between this period, we will apply IAS 10. If it happened before that or after that, don't apply. So if let's say there is one customer who owes money bankrupt already, and then the customer bankrupt on 2nd of January. So you know already what 2nd of January, the accountant of the company will actually do adjustment on the 2nd of January, right? So you're not going to do this event after reporting period. So that's the first thing you must know. Okay? So when there's an event happen, you want to see whether it is a condition or not. Alright? Now, so we are looking at this authorized date, and we don't care whether it's favorable or unfavorable because we're very objective. So you're not going to be biased. So the event is happy one or not happy one, whatever is it, as long as in between here, then you will apply IAS 10. Okay, then we will look at this. So the first step is we have to make sure whether it is under IAS 10. Then you go for the second step. Second step is if it is within the period and then you classify it as event after reporting period, you will move forward to the second step to make a judgment, professional judgment, whether this event is considered as an adjusting event or a non-adjusting event. Okay, only if it is IAS 10, then only you go for the second step, whether it is an adjusting event or a non-adjusting event. So adjusting event, there is an evidence of condition. Non-adjusting event is an indication of condition. Okay, so what does it mean? Actually, it's not that difficult. So adjusting event is like this. That thing has already existed end of the year in the financial statement. Okay, that thing, whatever event is it lah. Okay, the account title affected by the event, it has already existed end of the year. For example, the customer who owe you money, you name it as a trade debtors or trade receivable. Alright, both also can. I saw one of your answer, you wrote trade receivable, then you cut off, and then you wrote trade debtors. Actually, these two are the same. Receivable is a newer term. So if you have one trade receivable sitting in your balance sheet already, and then maybe in July or August declared bankruptcy, it is an adjusting event because that person already owe you end of the year. Okay, already existed, and then now you got further evidence this company that owe you money bankrupt already. Okay, so this is the easiest way of understanding it. Now, if it is adjusting event, what you have to do, let's say August, you know already, oh, this company owe me 100,000 and then now bankrupt already. I'm very sad, but no choice, I have to adjust it. I cannot chase after money already because that company is going into liquidation. So what I have to do, I have to go back to 30th of June, end of my reporting period, to adjust this event. So how to adjust this event? I will debit back that expense. I will credit trade receivable to make it zero because I cannot actually ask for the outstanding balance from this company. This company is on liquidation in August. So I have to adjust it end of the year in June. That's called adjusting event. Now, non-adjusting event. The event happened in between last day of the financial year until the authorization date, in between that day. However, it is only an indicative of condition. First time happening. It is not sitting in your balance sheet. So what is the example? Now, for example, August, suddenly there's one customer very angry and sue you to the court. The customer said, because I add the food that you provided, let's say you are a restaurant, okay, I add the food, I add the meal, I had a meal in your restaurant, and then after that I was admitted to hospital. So I want to sue you for 1 million ringgit. Just simply pluck numbers from the sky. Now, and this court case happened in August. So that has got nothing to do with anything end of the year, right? So it is a non-adjusting event. And therefore, if you put it under non-adjusting event, what happens is you will not do any adjusting entry. You don't debit credit end of the 30th of June. But if it is very, very important, okay, then you might have to disclose it in the note to financial statement. So for my story just now, it is related to module 3. So it is always interconnected, related to module 3, and then you have to see whether it is probable that you are going to compensate that person, whether the 1 million is measured reliably based on legal advisor, then you will see whether you disclose it as a contingent liability or not. No matter how it is fall under non-adjusting event. Okay, so if you look at this from your textbook, first step, you ask yourself a question when there is an event. Whether this event happened from 30th of June, from the end of financial year. If it is no, let's say it is 1st of June, then close case, don't have to continue thinking about it. Okay, so if yes, then you try to think whether it happened before the authorization date or not. Okay, if no, then you close case. Because if it is after the signing date, the board of directors signed already, you can't do much about it. So what you can focus is focus on the new financial year only. Okay, so we are looking at the event happened from the end of financial year until the authorization date. Okay, step 2. This one is step 2. Whether the event reflect the conditions existing end of the reporting period. If yes, we adjust it. If no, we don't adjust it. Okay, so for those who are like finding this like a bit difficult, you can look at all these examples to understand it better. So more or less the same if you keep on doing the exercises. Now adjusting event, right? These are some popular example. You don't memorize like, oh, court case, not adjusting event. Then what is adjusting event? No, now you have to understand it. Court case, it depends when does it happen. If the court case happened in August, the customer sued you in August, your financial year is June, not adjusting event. Okay, if the customer sued you on 1st of June and then the court case is ongoing, not finished yet, until August, finally closed case, the judge made a decision that you have to compensate that person, adjusting event, like that. So you see the existence, whether this thing exists already end of the year, and then you have a further evidence, maybe in August or whatever, like that. Okay, so this one we learned a bit in module 1, if you remember, IAS 2 inventory. So let's say in August, there's one competitor open a shop next to you, and then the competitor do buy one free two. So you understand that with your current condition, you're not able to sell your stock with the original selling price, so you will have a lower net realizable value. In August, you know about it because your competitor opened a shop next to you. Is this an adjusting event? Yes, because your inventory has been sitting in your warehouse end of the year. So you think like this, because your stock is already sitting in your balance sheet, right? And then normally your stock is like 20 ringgit, you can sell it at 40 ringgit, but now you think cannot already. You can only sell it like buy one free one also, or whatever is it. So you might have to do an inventory written off if your net realizable value is lower than the cost, and you have to do it end of the year, adjusting event. You have to do it end of the year. And of course, you're assuming all the stocks are sitting in your warehouse end of the year. You have not cleared those stocks before your competitors, set a company next to you. Set up a company next to you. Profit sharing bonus payment. This one related a little bit with IAS 19 employee benefit. So I told you already, if you declare bonus and then you're going to pay bonus, it is based on past performance, adjusting event. Okay, so let's say if your financial year is until 30th of June, and then maybe until July only we look at the appraisal form, KPI and all that, and then July our boss said, okay, everyone will have 1 month bonus. So this decision is made in July, right? In between 30th of June to 30th of September authorization date, right? So it is IAS 10. Second step, whether it is an adjusting or not adjusting event, because the staff had been with you during the past year, and because of the past year performance, you're going to give 1 month bonus, and therefore you have to go back to 30th of June, debit bonus expense and credit provision for bonus, like what we learned in module 1. And then error. Okay, for error, right, for sure have to adjust that. So if you find that the error has happened, let's say until August when you wrap up your account and all that, and then you found that, I did the depreciation wrongly, okay? Then you just have to adjust it on 30th of June. So this is not prior year error because you have not authorized the account, so you can actually adjust it. So you do not have to use retrospective adjustment. technique. You go back and think about it. You try to link everything together and see whether you can think about it or not. So they are a bit interrelated, by the way. Now then, examples of non-adjusting event. Now non-adjusting event, why I purposely color all the after is because if you are so confused, if you have one question and the question said that thing happened after reporting period, higher tendency the answer is non-adjusting event. So let's say on fire, let's say the share price drop, let's say you declare dividend, let's say you want to buy a company after reporting period, a non-adjusting event. Okay, so share price drop, let's say July, our share price dropped very sharply. Why is a non-adjusting event? Because the share price fluctuates every day. So you do not adjust anything 30th of June. So maybe July dropped a lot, then August increased a lot, then you're very busy like every day you go and change the 30th of June, no, right? So no. So if let's say you got a major restructuring and you started making the decision planning or whatever after reporting period, or you go and buy business combination, you go and buy a company indirectly, okay, you plan discontinued operation on fire, all these are non-adjusting event. Okay, so what is the meaning if we say non-adjusting event? Non-adjusting event means you don't do any debit credit, you don't do any journal entries on 30th of June. But if that thing is so important that it will affect the economic decision of the primary users, the one we learned in 41, then what you do, you disclose it in the 30th of June, you know, that financial statement in the note to account, the 5th financial statement, you disclose it. If it is very important for the users to know because it will change the economic decision, then you have to put it at it. So for example, we are now looking at 30th of June 2023 financial report. And then in August, our share price dropped 50%, which is very serious. It is IAS 10 because it is one event in between 30th of June until 30th of September, the authorization date. So the second step, it is a non-adjusting event because the drop in share price or whatever after the reporting period, we don't adjust it 30th of June 2023. But what we do, we disclose it in the note to account of 30th of June 2023. You don't do debit credit, you don't do any numbers, double entry, but you disclose it, you inform the primary users or the users of the financial statement that there is a major drop in share price and maybe explain why. Okay, maybe explain why. Then you can actually look at it on your own a little bit for this. Okay, now, so let's say this question. There's one company, the financial year end is on 30th of June, and then the authorization date for issuance is 31st of August. Authorization date is like the board of directors also signed already, then auditor also signed already, and then declare already. So it is getting ready for issuance already. So IAS 10 will take into place from which date to which date? From 30th of June to 31st of August. So if there's anything happening like in between this date, step 1 is fulfilled, IAS 10. Okay, then you go to step 2. This event is considered as an adjusting event or non-adjusting event. So this one on 30th of July, that means it is in between this date. Then we say, okay, IAS 10 applies. A major drop in the share price, okay, decline 25%, blah blah blah. Now, it is a non-adjusting event because the share price like fluctuate every now and then, right? So you don't take this as an adjusting event lah. So if you, So right, this is a non-adjusting event and it is so important and therefore you will actually disclose it in the note. Then the second one, debtors who owe a significant sum of money as at 30th of June. It has already existed in your statement of financial position. Okay, that trade debtors owe you money, and then now declare bankruptcy on 18th of August. So your first question is whether it is between 30th of June to 31st of August. Whether it is between this timeline. Answer is yes. So we go for the second step, whether this is an adjusting or non-adjusting event. Answer is adjusting event. Yeah, because the debtors owe us money end of the year. So if this is an adjusting event, you have to adjust it on 30th of June. So what you will do is you will debit better expense, you will credit trade receivable. This is only an assumption, for example, 20,000. Okay, so my assumption is, let's say John owes us 20,000 end of the year. Then now suddenly bankrupt already. So you have to adjust it on 30th of June. You have to adjust it 30th of June. Then you will do this. Eventually John no longer owes money because we cannot actually get back the money. Then the third one is a major explosion occurred on 20th of July. And then it causes significant losses for the company. And then the company has to spend a lot of money to do a lot of repair, or clean up the place and so on. Now this happened after the reporting period. In between, okay, it is in between, so it is IAS 10, but this thing happened after. So whatever disaster like water flood, fire, explosion, all these are non-adjusting events. Then, okay, now, so part A done already. So part B, more or less we also completed already. However, there's one thing that we have not done for sure is reclassification adjustment. But before that, let us go through a bit of things first. Now, the one that we have done is like this. You remember this is not IAS 1, presentation of financial statement. And then I told you paragraph 82 is the basic, the minimum requirement. We have to, if you have all this transaction, you have to make sure this is presented in a separate line item. That means one row like that. So paragraph 82, you will not see gross profit here. It is not the minimum requirement. So this is called paragraph 82. Now, for the expenses classification, either it is by nature or by function. Now the one that we like to use is by function, you will see gross profit. By nature, you don't see gross profit. So by function is the one that we study all the time. I think you study all the time, not sure whether I'm correct or not, but we study all the time like this. By function, function. You look at the function. So we classify our expenses under distribution costs like traveling expenses, petrol, this we will put distribution costs, lorry, whatever distribution costs. So administrative expenses normally is like salary, medical expenses. Some company medical expenses they put here or put here. So no right or wrong, doesn't matter. But we will group based on different function. And if we think that this is called administrative expenses, then we will park underneath it. And then many of us will have operating expenses as well. So these are by function. Now, okay. If you remember, we said statement of profit or loss and other comprehensive income. You can put it into one statement or you break it into two different statements, right? Now, and I told you other comprehensive income, actually they have two different categories. One is will not be reclassified subsequently. One is will be classified subsequently. So today we are going to focus on this. A little bit confused, alright? Now, as for now, we remember two different account titles enough already. Cash flow H is a very horrible one. We never studied in our lifetime before. We're going to study in Module 6 Financial Instrument next time. So now we remember two things only. One is asset revaluation. This is the revaluation surplus or revaluation reserve that you study all the time. I mean, at least you study many times before. And I told you RROCI, right? Or RSOCI, right? This is the one. So for example, we have a piece of land. Okay, the company bought a piece of land. So the company used that land to collect car park. So it is under IAS 16 because it is for ordinary business purpose to generate income and all that, right? So the company wants to use revaluation model instead of cost model doing depreciation. So what the company will do is every year the company will have to find a valuer to revalue that land to to see the market value, like something like that, IFRS 38. So let's say the piece of land revalue upwards from 50,000 to 60,000. So what you will do, you will debit land 10,000. Then you will credit revaluation surplus 10,000. So yang tu, revaluation surplus or revaluation reserve is actually OCI, equity component. Now, however, now we study a little bit more. The movement during the year will appear in our statement of other comprehensive income. The movement during the year, that means increased by how much? Increased by 10,000. 10,000 will appear here. So the opening balance 50,000, the revaluation surplus 50,000 opening balance will appear in statement of changes in equity. So the closing balance 60,000 whatever is it lah. So if I assume that my revaluation surplus opening balance is 50,000, it will appear in my statement of changes in equity brought down. Then this year, if I want to increase 10,000, then 10,000 will be under statement of profit or loss and OCI here. Then my closing balance will appear in two places. One is statement of changes in equity, one is balance sheet. And therefore, I really think that it will actually help if you wait now. So that's why I think it is quite important to look at White Prop case and Tapwood case for those who enter class a bit late today. For those who are quite not so like technically strong, you just look at the answer, look at the numbers. Why the trial balance number will slot in like this in income statement, in balance sheet, in statement of changes in equity. For those who are better, then you look at trial balance, you fill in the blank yourself, so that you can see the whole flow and you will be able to understand, it in a better way. Okay, so basically this is about revaluation surplus in OCI. Now another one is the one that we never studied before. There's called foreign operation exchange difference. Currency exchange difference on translating foreign operation. Now what does it mean? Let's say I'm a Roti Boy and I open a Roti Boy outlet in Jakarta. So Jakarta is a foreign country because over here is Malaysia. So this is known as a foreign operation. So when I actually establish a Roti Boy outlet in Jakarta, then probably the cash inflow outflow are all in Indonesian rupee, right? So there will be a currency exchange difference, right? So I'm not like buying a piece of land in Jakarta, one off. It is not like that. I'm having a business in Jakarta. It is a daily business. And therefore, what I have to do, end of the year, I will have to retranslate to the presentation currency. Like a little bit like the one you're studying in Part 4, but not that difficult. Not that difficult like Part 4, I should say. Okay, so I will have to translate from Indonesian rupiah to Ringgit Malaysia, and there will be either an unrealized gain or unrealized loss end of my financial year. Okay, this is called exchange difference on translating foreign operation. So we remember these two things only as for now. Okay, so OCI is an equity component. The movement will appear in statement of profit or loss and other comprehensive income for the year ended 30th of June, blah blah blah. Now, asset revaluation surplus, that movement, increase or decrease that movement, is actually categorized as will not be reclassified subsequently. No recycling. In other words, it's sometimes you will see the answer, what is not non-recycling and recycling. This one is non-recycling. You don't recycle it. That means if you sell the piece of land, you don't want to collect that part already. You sell that piece of land one day in future, you de-recognize the land, and your revaluation surplus balance, you will not recycle up there to profit or loss. You will not debit out or de-recognize your revaluation surplus and credit again, which will increase your net profit. You will not do that. that's called will not be reclassified subsequently. So what you would do, you will derecognize your reversion surplus, you will debit out your reversion surplus, but you will credit retained earnings, like what I told you a little bit that day. You will credit retained earnings. You will not actually make an impact in your profit or loss statement. If you sell that land and then you derecognize the land and your RR, you will not recognize, like a gain or what like that over here. You will not do that because it is under will not be reclassified subsequently, means next time subsequently when you sell something. So for exchange differences on translating foreign operation, it is part under will be reclassified subsequently. Okay, get it already. Now, there's one word that I said today we have to learn is called RA, reclassification adjustment. Reclassification adjustment will only happen for the account title falls under this category, will be reclassified subsequently. Okay, and luckily for CPA module, right, CPA scope, right, we only have this as an example. This is the only thing that we will learn for RA. Okay, so whenever you have a question, right, whether this has RA, this has no RA, and so on, reversion surplus for sure forever, no reclassification adjustment. Only this one got, because only this category will have a reclassification adjustment on the day of disposal or transfer out. Only this one. Okay, now. So we will learn a bit what is it about later on. Now, so the next page, the next slide. So we have two categories. One is will not be reclassified subsequently to profit or loss. One is will be reclassified subsequently, right? Now, there might be a reclassification adjustment only for this type, not for the rest, only for this type. And reclassification adjustment will only happen during disposal or transfer out. Why is it so? The main reason is because we want to avoid double counting, and I'm sure you don't understand what I say. So we will look at an example. Okay, avoid double counting. That means you don't want to double count something. So we will look at the example. Wait, I jump a bit since we're talking about okay. So we'll look at question 2.7 as an example, and so my class teaching note is over here lah. So you can see 1, 2, 3. The third one, profit or loss, somewhere around row number 30, reclassification adjustment. So on top, I actually tell you about like revaluation model, cost model. If you use revaluation model, your land revalue outwards, what you have to do. Actually, there's a DTL, but today we don't learn first lah. This is not the final answer. Module 4, there's a DTL. So this is the answer as for today's syllabus lah, not the final answer. So yeah, and then now we are actually looking at this reclassification adjustment. So you see whether you can get me or not slowly, whether you can get me or not. So this is a bit difficult lah. Now, so we are talking about B. We have one foreign operation, and there is an exchange difference because that one is another country. So on the disposal of the investment in the foreign operation, we will have the total foreign currency exchange difference accumulated in equity over the life of foreign operation, and it will be reclassified subsequently, right, to the profit or loss. So we assume that finally today we dispose it. So you imagine, okay, I'm a roti boy Malaysia, I open a roti boy in Jakarta. So today I dispose this foreign operation. Okay, so and today when I dispose it, I found that right before I had a recognized accumulated exchange difference gains net of tax through OCI of $7,000. Okay, very long. What does it mean? Now, recognize means you recognize in your balance sheet already, accumulated, right? So this is actually, closing balance lah. Yeah, right before disposal. We want to zeroize it. We want to derecognize it later on. So accumulated is from last time, day 1 we had our foreign operation until today, right before disposal. We accumulate until now, like your accumulated profit like that. When you say you have accumulated profit, meaning last time, year 1, I profit 20,000, year 2, 10,000 becomes 20,000 now, and then year 3, 10,000 profit. So you accumulate. So last time until now, right before disposal, we actually have an accumulated foreign exchange gain of 10,000. Okay, 10,000. And then 30% tax rate. And therefore, our net of tax is 7,000. Now, of the accumulated exchange difference gains, 2,800 net of tax related to the current reporting period. So are you able to calculate brought down, movement, and carry down or not? Okay, so you think slowly. Now, these are the numbers, right? So we try to think slowly. What should I do? Let me think. Okay, now you think slowly. My carry down before I dispose, I have a total of 10,000 foreign exchange gain. But tax rate is 3,000 lah, that's why 7,000 So 10,000 is my, maybe I do this, I know already, okay. So maybe we plug in the date so that we are not so confused. So let's say our year end is 30th of June 2023. And let's say today we make a decision to dispose it, and today we really dispose it lah. Okay, so 30th of June 2023, right before we dispose it, our accumulated foreign exchange gain carry forward is equal to 10,000 gross amount. Okay, so when I dispose it, I must be recognize this thing lah. Kan? So accumulated foreign exchange gain is actually an OCI account title. Normal balance is credit side. So maybe I write here. So this is OCI account title, and normal balance meaning normally by nature normal balance is on credit side. So this 10,000 is credit side lah. This is gross amount. Now, and then we mentioned in the question that of the accumulated exchange difference gains, meaning out of the 10,000 carry down right before disposal, 4,000 gross amount, this is net of tax, 4,000 gross amount is actually the current year movement. So I know that in the current year, financial year 2023, in the current year, we have a forex gain of 4,000 gross amount. This is the movement during the year. Okay, my question is, are you able to calculate the brought down? Can lah, I think can, right? So are we able to calculate the accumulated foreign exchange gain brought down, which is on 1st of July 2022? Equal to how much? So we always say last day of the year is equal to first day of the year plus all the movement during the year. That means X plus 4,000 equal 10,000. Okay, so X is equal to how much? 6,000 no? Like that. Okay, so but then the problem is we have to do the tax rate. Now for OCI, there are two methods. So if we look back our format, right? If we look back our format, this one, you will find that you are more familiarized with statement of profit or loss. You do one shot already, and then at the bottom you got income tax expense. That one is your tax lah, 30% tax rate, but it could be due to different tax as well. So OCI, there are two methods. Now you can do like the one you did for statement of profit or loss. You do all the gross amount already. Then one shot, 30%, you name it as income tax. Then after that, the total is other comprehensive income net of tax. So you can do like this. The second method is every account title you can do net of tax, net of tax, net of tax. So there are two methods. So for OCI, there are two methods. So right, now we are talking about story here, right? Exchange difference on translating foreign operation, right? So you can do gross amount like 10,000 or whatever thousand, then you do income tax 30%, you total up, you do income tax 30% one shot, or you can do one by one. Exchange difference on translating foreign operation net of tax. Net of tax, then you don't see income tax here already lah, because you do net of tax, net of tax, net of tax, net of tax, like that. So OCI, there are two methods. Now this question says net of tax, so we do net of tax. So this question tells us net of tax, so we can actually do net of tax, net of tax, net of tax also. So how to do net of tax? We are assuming that the tax rate is 30%. Okay, so if the tax rate is 30%, then you can do even slower. So we have a tax rate of 30%. So you just do slowly. Oh sorry, I forgot to lock it. After tax or net of tax, net of tax is a better term. So net of tax will be equal to this minus this. And you remember I told you we can do faster, right? Because next time we always do net of tax. So net of tax, if your tax rate is 30%, net of tax will be the gross amount times 0.7. I mean 1 minus 30%. If your tax rate is 20%, then your net of tax is this amount times 0.8. So net of tax is actually the gross amount times 1 minus the tax rate. Okay, so if let's say I do 4,000 net of tax, 4,000 times 0.7 is 2,008 lah. So you can do slowly. This one times 30% is this one minus this one is this one. But why not you just do this times 0.7 is this one, you know, really there. So you can do that. Okay, so this is net of tax. So today, the 3rd of June, we have decided to dispose it and we managed to dispose it. So once you dispose it, what are you going to do? You will zeroize it. You will debit it out because just now we said normal balance is credit side, right? So when you decrease it to zero, you have to debit it out, right? So when you debit it out, then what are you going to do? You will actually debit this thing out. You will credit profit or loss. You will debit the gain and it will increase your profit for the year up there, because this is considered as this is classified under the category of items that may be reclassified subsequently. So next time subsequently, which is today, we want to dispose it already. So recycling means we will actually realize it up there. Up there. Okay. Now, so if we want to do like this, that means just I'm assuming the 30th of June 2023. So the whole thing 10,000 realized upon disposal, I will put it up there. Okay, and then my profit for the year will increase by 7,000. So 10,000 gross amount, 7,000 net of tax. It is actually the one that we explained over here just now. Because I want to zeroize it, I dispose it already, so I want to debit, do the opposite. I want to debit accumulated foreign exchange gain, make it to zero. So what should I credit? I'm going to credit gain, for forex gain, realized gain. A realized foreign exchange gain. So now finally this gain is realized already because I'm not running the operation anymore. Gross amount 10,000, net of tax 7,000, and it will actually appear over here like this. Up there, this one is up there, statement of profit or loss that side. This one is up there before the OCI, up there. So we recognize 7,000 total realized gain, net of tax. I wrote it here. Now, there's a problem actually. Now, let's see. Then we move on to OCI. Okay, now OCI, items that may be reclassified subsequently to P or L. Exchange difference on translating foreign operation. Are we going to fill in any number? Answer is yes. 2008. Why we have to do this 2008? We have to do this 2008. It is because it is the movement during the year. You remember just now I told you the OCI one, we are actually reflecting the movement during the year. And just now I told you the story about we revalue our land upwards from 50 to 60 by 10, right? So the 10,000 movement, it will appear in your OCI reversion reserve. That's like increment. So the foreign gain movement during the year 2008 will actually appear here. That's the movement during the year I color in red color. If I do net of tax one shot. Okay? Now, the problem is like this. If you remember your basic statement of profit and loss and other comprehensive income, sometimes I write shortcut statement of comprehensive income or income statement, I just simply write. For the year ended, we are only writing everything for the year ended. You only write your sales during that year. You only write your cost of goods sold during that year. You don't write anything before that. However, when I dispose a foreign operation, the total foreign exchange gain, I write it here. And this total is actually not for the year. For the year is how much? 2008 is it? So there's a double counting problem. So you see, when is the gain for the year? For the year is movement, right? Just now we mentioned already, right? All the gain, all the loss, expenses and all that for the year, it is during the year, the movement, which is 4,000 gross, 2008 net, right? However, we are including 7,000 in our statement of profit or loss because it has been realized it is recycling, we have to put like that. So the 7,000 is double counting. 4,002 last time we have already recognized in our profit or loss throughout the year already. Then now we also recognize 2008. Then now we somehow recognize this 7,000 block. This one is double counting. So how are we going to tackle this? We have to write one more line item called reclassification adjustment to the balik. If you throw the total gain on top and you increase your net profit for the year 7,000, you have to decrease it back by minusing it out. So if this is a loss, if this is a negative, this is a positive. If this is a positive, this is a negative, because you want to set it off to zero. So the main function is to avoid double counting. Now for those students who really don't know what I said, never mind. At least you have to understand from this story, right? You have to understand reclassification adjustment will only happen for items that may be reclassified subsequently to profit or loss. Our only example is foreign operation exchange different. It will only happen when we dispose it or transfer it out, and you are actually repeating the one in profit or loss, you negative it only. Then finish already. Okay? So now the next thing I want you to learn is this statement. Yesterday we mentioned a bit, we have two parts, right? One part is statement of profit or loss. You got profit for the year. The first part, right? You got profit or loss, you got profit for the year. Second part is OCI. Then you got total OCI. Then after that, what you do, you remember or not? You will use profit for the year plus OCI to get CI. At least you have to know this. Okay, I repeat again. You have to use your profit for the year plus with your total OCI, net of tax, it is equal to total CI. That means, let's say if the number is 7,000, you use 7,000 plus 4,002, but this is a bracket, so you minus lah. Okay, you sum them up, then you will name this as total comprehensive income 2008. Like that. Okay. Now, the second thing we have to learn is for statement of profit or loss, you do all the gross amount, then you do your income tax, then after that you have profit for the year, which is profit after tax. But for OCI, right, there are two methods. You can do net of tax like that, or you can do the gross amount. Two also can, or you can do like this. You write the gross amount. Gross amount is 4,000. A gross amount of reclassification adjustment is 10,000. That means you do this one, gross amount also can. Here also can. 10,000 for this one also can. You do gross amount already, right? Then only you one shot do income tax 30%. You will get the same answer. These two are okay. Then the third thing you have to learn is from your statement of profit or loss and OCI, how are you going to transfer the numbers into statement of changes in equity? So you have to learn slowly. You have to be patient and look at it slowly. Now, so coming back to the easier one, difficult one we covered already. Coming back to the easier one. So just now I told you, what did I tell you? What did I tell you? I told you that profit for the year refers to net profit after tax. Profit for the year is after tax. Now, profit for the year will be transferred to retained earnings in your statement of changes in equity. OCI will be transferred to the statement of equity based on the column. Normally it's reserve column. So, and then one more thing I would like to ask you, this plus this is equal to what? The easiest question. This one plus this one is equal to? This one? Profit for the year plus OCI is equal to comprehensive income. Profit for the year plus OCI is equal to comprehensive income. So one of the senior mentioned is correct lah. Maybe you should actually bring the format to the exam hall. Maybe it's correct. So what I'm trying to say, profit. This one you do profit before tax, and this is profit for the year, right? Profit for the year plus OCI net of tax is total CI. Okay. Now. Then we move on. Okay. So now we are going to look at this example. OCI non-recycling. That means will not be reclassified to profit or loss subsequently. So this is the web prop case that you can do it on your own, but we are only zooming into this part. I think when I introduced you, I highlighted right. There's a reason on that lah. So we are going to look at RR or RS. So the story said that during the year, the building revalued upwards by 150, and during the year, the land reduces by 230. Okay, now I would like to ignore tax effect. Actually, there's a tax effect, but we don't learn that first. Now, I would like to ask you a question. This building and land is fall under which standard? Is this investment property? Like what you did just now, is this an investment property? This two land and building. Is this an investment property? If not, what standard is this?
IS 16.
This is property plant equipment, IS 16. If it is an investment property, we have to write it is an investment property. So if you look at the web prop case, I think I printed it. Okay. I actually reprinted separately for the web prop case. So I see section 1 is a brought down. By the way, I don't expect you to look at it yet. So basically, right, if you can see the brought down, 30th of June X6 is the balance brought down because we are looking at financial year X7, which will start from 1st of July X6 to 30th of June X7. So you see, you only zoom in land and building. So you see, land is 1.2 million. Why no depreciation? Because maybe this is a freehold land, and then maybe we are using reversion model or whatever. So the factory building is 1.6 million. Okay, net book value, carry amount. So now we want to increase the land by, I forgot already, 400,000. Let me see. Oh, sorry. We want to increase the building by 150,000, and we want to decrease the land by 230,000. So all in all, what are you going to do? Because you increase 150, you decrease 230. Decrease more than increase, right? So eventually, we are decreasing our reversion reserve by 80 in total. Now, so what are we supposed to do? You remember statement of profit or loss and other comprehensive income for the year ended 30th of June. For the year only. So this one, we will include only the movement during the year. You are not going to write the carry down. So during the year, you will write revenue all the way until profit for the year, right? So the second part is OCI, if I want to do one shot. So OCI, I have two categories, right? One category is item that will not be reclassified to profit or loss, which is revaluation surplus. and I want to do net of tax, or I assume it is net of tax. We don't want to learn the tax effect first. So land and building, building we revalue upwards by 150. So your movement is you increase 150 now, you debit your building 150, you credit RR 150. And then for land, right, you credit land, it reduce, right, you credit land 230 and then you debit RR 230, provided you have enough reversion surplus balance brought down. Because we cannot reduce it until negative for reversion reserve if you forgot already. So by the way, this slide will help us to appreciate that we are only writing the movement, the increase, decrease in your statement of profit or loss and OCI, not the opening balance and closing balance. So this one is increase, decrease movement only for the year ended, right? So that's the movement only. So, okay, and now, so this one we will actually use what? These expenses is by nature or by function. Answer is by function, because we can see the gross profit, we can see different function like admin expenses, other expenses, finance expenses, and so on. So you will see paragraph 99 here. Paragraph I think not very important lah. So this is statement of profit or loss and other comprehensive income. But if you compare with the paragraph 81, 82 one, that one might be longer because this one is by nature, that one is by function. Like that. So 82, this one, 81, 82 is the minimum requirement. At least you must have this as a line item. Okay, but if you are doing by function, right, it is longer. So you see 81, 82, if you look at the profit for the year is 903,000. OCI is 80,000 negative, and total CI is 823,000. So if you go to the slide 50, I think, you will get the same answer, although it's longer. It is longer lah. It is longer. Profit for the year is 903,000. OCI is 80 negative. Total is 823. So you use the longer one, shorter one, also the same answer. Just that the breakdown is different. So if you are very confused why they ask 2 times the same thing, actually it's like this way, nothing much. Then, okay, no more already. Then okay, so this one is statement of changes in equity. Alright, so what we can see from here is like this. 700 lah.
What the reclassification adjustment? So the major, major, is it drawback or like, was it like the impact on our statement is like only the movement, is it?
Yeah. So RA will only appear under the OCI, which is will subsequently reclassify to profit or loss there, and then it is only the negative of the one from statement of profit or loss, because we actually only want to show the movement, and the movement is actually shown OCI, the foreign operation exchange rate transaction there.
So that's only impact in our profit.
Yes. So the impact is your profit in that story. The impact is your profit will increase by 7,000 net of tax, and we actually reduce it through RA, which is under OCI. So people will not know also, because your profit already increased by 7,000.
But our CI is only
only CI you can get back that 2008.
I see.
But when do tax will add back lah actually. Okay, so coming back to this question, just now we said this one is balance brought down, right? And then I forgot to tell you one thing. Share capital brought down is 1.05 billion. Revaluation surplus brought down is 700,000. So we have a lot of brought down. That's why if we have a movement of 70,000 drop, that one is okay. And then retained earning brought down is 843,240. Then you learn how to use this to prepare your statement of changes in equity. So your statement of changes in equity, you're brought down. This one, start from this, and then you see your PowerPoint slide answer. So Webprop, we are now in X7. So the 30th of June X61 will be our financial year X7 brought down, which is this first line. So you have 3 columns because these are all equity component, right? So you have the share capital column, you have the reserve column, you have the retained earning column. Then you copy it. These, and these are all copied from where? These, they are all copied from the trial balance last year, which is brought down this year. These 3. You just copy it. Then after that, these 3 you just copy. Okay, then the second line item will be like this. Some of them will write total comprehensive income. Then you fix it into like one line item, total comprehensive income also can. Then you just combine as like one line item. But we want to make it clearer, we put like 2. So profit for the year, 903,000. Just now we saw, right? Profit for the year. From here we saw from here we saw profit for the year. Profit after tax is 903,000. Okay, so you just copy, it's like 50. Then you just copy and then you paste it here. Under what? Don't simply paste. Paste in the column of retained earnings. It will increase your retained earning. So later on, your retained earning carry down, you have to sum them up. Then it will be equal to the amount. But in this question, because they pay dividend, 30 cents or something like that, I forgot already. So dividend will reduce retained earning. And you will reduce your retained earning when you declare the dividend, not until you pay. Once declared, then you can do the journal entry already. Okay, then the second thing is, we revalue land upwards and building downwards. So when you net it off, it is 80,000 negative, right? So during the year, OCI, you will write it here in the column of realization surplus. So after you have done that, you sum them up. Our realization surplus carried on is 620. Share capital, no new additional shares. So same thing. Then this plus this is equal to your total equity. So one more time, I'll repeat. Statement of changes in equity, your balance brought down. First row, you copy from the trial balance, opening balance. Copy, paste one by one. Copy from share cap, reversion surplus, and retained earning. That's from section 1. Section 1, this is the balance brought down. You go to the second page, don't know which page, 111. You copy from here. Then the second row, right, is the movement. This one is the movement. You copy from your statement of profit or loss and OCI that you have just completed, for example. And then dividend you calculate on your own. How many shares times how many cents per share. Then you write it there. After that, you sum them up. This is equal to this. Now, the last row, right, is the carry down. You have to match with your balance sheet, statement of financial position. This one, this, you have to make sure your statement of financial position, share capital carry down is 1.05 million, realization surplus is 620,000, everything earning is 1.296 million. That's how you should do actually. So, okay. Like this. So in slide 67, right, Webprop statement of financial position, this number will be the same as your statement of changes in equity, the last row, last line item. Total is 2.966 million. So you have to do it with your full focus when you are very energetic, you are very happy, you know, you want to sing song, then stop, don't sing song first, you do this one first, then only sing song, okay? So, okay, so the last one is statement of cash flow. I will just give you direction now because statement of cash flow will be the same like what we have been doing all the while. Now it's like this. It is not because it is not important. Now, we will do, after a short break, we will do module 3 already because we are a bit late also. Now, you see what happened. Now, you can watch this to understand basic cash flow and indirect method, but the more important one is actually direct method for operating activities. So maybe I just brief you a little bit to refresh your memory, assuming that you cannot remember already. Now, cash flow is like this. I will just tell you a couple of things. Okay, you listen carefully. Now, when we have a cash flow, we will name it like this. Statement of cash flow for the year ended. It is also for the year. Why? Because the main objective of doing this under IAS 7 is to see the movement of money. We want to see the money increase during the year or decrease during the year. That's why we say for the year ended. Okay? And how do we know increase or decrease? It will be at the bottom. The last one, you will see net increase or net decrease. And then you will add with the brought down equal to carry down, because we always say carry down the last day of the year, how much you have is equal to the first day of the year plus all the movement during the year, right? So movement plus brought down is equal to carry down. So this is the last part. So how do we know whether there's a net increase or net decrease? We will add up 3 activities. What are the 3 activities? We have financing activities. We have investing activities. We have operating activities. So there are 3 activities. You will sum them up to see eventually there is an increase or decrease. Now, a lot of students are very confused, don't know which one is which one, right? Now, very easy. If the company asks for funding, all those are financing activities. Okay, let's say my company has no money. What should I do? Borrow money, issue share capital, or I issue debts. Okay, I issue securities, bond. Okay, so when you issue capital to get more money, when you go and issue debt security to get more money, or bond get more money, or you borrow money from the bank, all these are financing activity. Makes sense, right? You get your funding through borrowing money or asking people to support you because you want to finance your business activities. So all these are financing activities. So proceed means you get the money now. Alright? So when I issue share, I get money from the shareholder, I got more money, cash inflow. If I have to pay back in the form of dividend, cash outflow, or I borrow money, so now suddenly the bank borrow me, lend me 1 million. So this is called proceed. So I have 1 million cash inflow, positive. If I pay back, then I have cash outflow, like that. Okay. Now investing activities. Normally investing activity also quite simple. If you invest in buying fixed asset, you think that the table will help you to earn money. You think that the land will help you to earn money. Okay, or you go and buy shares in Maybank, you think that Maybank shares will help you to earn dividend. These are all investing activities. Okay, so normally, right, when you want to do financing activity, you go and find the equity component and long-term liability component. What is the borrowing and the share cap increase or not, like that. So when you want to do investing activity, normally you look at non-current asset. We own some fixed asset or investment in equity like Maybank share, for example. So if you go and buy something, you have less money because you pay money to buy, right? Cash outflow, negative. If you go and sell something, you will get a sales proceed. So I sell my V and then I get 20,000 ringgit. By selling my V, I will have a sales proceed of 20,000 ringgit, cash inflow. Okay, so if I invest by lending money to a company and I receive interest, if I buy Maybank share and Maybank give me dividend. Okay, the last one is most of other things will be in our operating activities. Only operating activities, there are two methods. One is the direct method. This one is very popular for exam purpose. One is indirect method. So one more time. This method is only for operating activity. Other activity no method, only one method. So operating activities got direct method and indirect method. A lot of time exam will come out direct method. because IAS 7 encourages company to use direct method for operating activities, but 99% will still use indirect method because direct method is for perfectionists. It's very, very tedious in reality. In exam, very easy because they will only give you a few things like sales, trade, debtors, exactly like the one you have test in FAFO. Okay, so direct method, directly you can see money coming in because customer pay you, money going out because you pay your employer and supplier, you pay interest, you pay income tax. So this is direct method. We can use T account, we can use formula method, and you must watch back the rows shortcut if you forgot already, and do all sort of question here. This one got time, no time also must do. This one must do. I must do. Okay. Now indirect method is this. Indirect method means you cannot see directly the money coming in and out because you're looking at increase, decrease like that. So my suggestion for you to do cash flow is like this. I don't know whether they updated our Eurox cost card already or not. Yeah, I really don't know where. Never mind. But anyway, just now I've updated FAFO cost card. You go and do this. Maybe I drop it now. For a lot of things to do, you will get like more and more. What do I do? Maybe FAFO is easier. Cash flow. 10 marks. You remember you have this or not? Daffodil, and then you have tulip, and then you have so pretty. Tulip and daffodil. Rose, pansy, and also one is called daisy. Okay, so you have all this. Do all. Okay, very easy. You do one already, the rest all the same already. So this one is like daisy. So I give you these two. I give you these two now, and then okay. So these are the one that you have to do. And then wait, I forgot already. And then you can watch FAFO BP. I've just completed for next week. Cost card. I think you try to watch one enough already, then you do your stuff the rest. No marks, this one is far for no marks. Okay, so we take a short break, and then after that we do a new module already. 11, 10, 11, 15 like that roughly. Okay, go. No profit account title. Mana ada profit account title? You look back the answer already or not?
Yes.
So you have to match back with your answer and see what is correct, what is wrong.
I don't know, like they write them. Thank you.
Yeah.
Ada result.
Ish, tak.
Ini tengok.
Kita nak buat yang
takut dah.
Tengok dekat Asha punya ni. Boleh. Asha ada buat. YouTube. Bukan. Apa tu? Oh, Asha punya. Alright. Asha punya. Sekejap. Untuk YouTube. Dia tak video kan? SMP kan? SMP tu buat FR ada sini. Asha buat macam ni je. Nama Asha. Ni kan je. Lepas tu buka kat Asha punya. Ni. Asha tu buat playlist. Dekat playlist ni semua video dah kumpul sini. Asha buat playlist. Asha ada ni mesti lah. Ni lagi. Okey, faham. Kau dah tengok kan? Dah.
Pakai sombong.
Tak mahu ada di sini. Tengok Aisyah, kau tengok baby, kau tengok kat toilet je. Jangan sangat. Itu dekat bawah meja-meja. Jangan cakap baik tengok kat toilet Aisyah. Dia kat sekolah Aisyah. Jauh betul. Aisyah baik, Aisyah betul. Apa tu? BSA. Aku dengar tapi tak kiranya telefonan ni mistake ke tau?
Ha? Kami kita check contoh je. Semalam kita orang duduk berjemaah kat sini.
Satu petang.
Kau bila faham?
Lepas tu korang dapat. Korang ada kan? Dapat. Dia FM mau.
FM.
Satu okey lah. Selalu yang kita dapat dengan dia kan.
FM.
FM kita sama lah. Dapat apa?
Sama dia kita.
Dia tak
Tengok member
Dia macam dia. Tapi je dia kena cakap. Tak ada cakap kan.
You forget have class today.
So I just met Kalis at 11 dan cakap, "Why you program?"
You are here, is it? I thought also raining or whatever. That means you didn't look at the group WhatsApp, is it?
I tapi tak tengok sangat. Semalam pun sebabkan reply yang dia coming late. So I cakap, wah dia tak suka.
Oh yeah, forgot.
We got test.
Oh how? Which module? Champion then. Module 1 and 3.
Graded.
Huh?
Graded.
Oh, graded semua. Then how is your preparation?
For calculation, okay, but for the theoretical, we still not finish.
Just a little bit like that.
Ini lah.
Oh, dah. Belum sekali.
Afrik also SMA already. No wonder you're around. I think they have made a decision to drop it in here. I'm not sure. Last time it's 3.75. I think they said they want to drop it now, but drop the level because some PDPS students will get that. Because she's a police so she will discuss us to know about like those admin things, the latest updates and so on. Oh, 1 PM is lunchtime.
Media, will we discuss about the Friday class? Have class or
Okay. Wait, okay, send. If that's the case, I'll let me think. Today is Wednesday, right? Every Wednesday got assembly class. Can? Okay.
and tomorrow replacement. SME also.
What time?
After
But tomorrow got
after FR.
but tomorrow no exam already lah.
Still have 2 days.
Oh, 2 days also exam ah. Who got SMA? Who has no SMA class? I should say about it. Aiman also got. I forgot already. Aiman also SMA. Oh, okay. Tomorrow is which module you are sending exam?
Don't know. As Sir said module 1 and 3. Maybe for both day module 1 and 3. Because
You study any which module already? 1, 3 and what?
1 and 3 only. But still for the theory still not finished. Because the calculation is we already do in the class, right?
Kalis break pergi gym bukan dah. Tak, aku banyak kali tersalah. Aku kan ambil SM. Aku kan di briefing class start. Saya belakang. Oh, dia punya sweet.
Hello. You know what did Mr. J say or not? No, he said no. You carry on with your class. Every week I will have class. This one is every week I will have tests. All these are very small tests only. Kacang putih. Then I said, today or tomorrow, impossible like module 1 and 3 today and tomorrow, right? Then he said, I will have tests like every time.
Yesterday after FR we study like crazy and then
And then you tell me tomorrow what happened today lah. Okay? Okay lah, I must say female and male setting are forever different. They are memang relaxed. So
Sir said ungraded test.
No, he didn't say lah, but he said like, that's very easy. Every course I give tests now, everything you want to dismiss already.
His definition is easy is different than
Next time you know. First time right? First time with Mr. J right? Except for Malaysian text. Malaysian text, you know, like because no need to grade forgiveness assessment, right? So next time you will understand his style. I don't tell you, you experience the
Nota? Apa? Tidak buat nota.
Tak, ini sebenarnya.
Esok.
Oh, dia buat sendiri ni. Tak apa. Macam mana every slide lah.
Okay. I think it's like this about the one more replacement class. After you see, listen. You know what happened? Because we missed our classes, right? The time university semester is ongoing, and therefore we want to do like one shot now. The story is like this. That's why we do Tuesday, Wednesday, Thursday, Tuesday, Wednesday, Thursday. Like now, so what happened is we still have one more class to be replaced. So I think maybe if you want to do it this Friday, I'm okay because semester has not started. I mean, for me, it's not started. So it's up to you. We have one more class to be replaced. You want to do it this Friday or another time?
This Friday.
Okay, maybe we do a vote like if Friday, what time we want to do? Maybe I have to stop for a while at 11 o'clock if the meeting is on lah. There's one meeting with Australia. Not sure. Because our meeting always change here and there, so don't know whether it's on. So if Friday, what time do you want first? Before prayer or after prayer? If before prayer, then we try to make something like 9:30 to 12:30 like that. Cannot.
Maybe I will come little bit late because I have a UR budget slot for rotation.
You mean our activity, is it in campus? Until what time?
9 until 10:30.
Okay. So who wants to do this Friday 9:30 to 12:30? So we got one and the one already. If you want, then next time only we talk about it next time. So, but we have to remember it. So who wants to do our last replacement class this Friday 9:30 to 12:30? I just don't want to know, nobody want to raise up the hand. 1, 2, 3, 4 only. Okay, who don't want to do this Friday and do next time for the replacement class? Okay lah. So maybe we do next time or wait for them and ask one more time. Okay, so because the study guide is not arrived, we want to do next time also never mind lah. So we will just suffer a bit. Okay.
Senior no.
Okay, we will start now. And then we will try to stop right after we finish this one because some of you have a test, right? But you have to get ready this semester. Mr. J actually discussed with me. He wants to give you a lot of tests until you felt it is almost the end of the world, so that you will study harder because we felt that previous semester we have very high absence rate, so the student macam cannot feel that urgency. So this time he wants to change his pattern, which is understandable. Okay. Since some of the seniors mentioned that my note works a bit, so I'm going to use this to talk about the first half of IFRS 15. And since many of you have SMA tests, and you're going to have it like every time, like today, tomorrow, as long as you see his face, you have a test. So you just have to try to seek for balance, to relax and study at the same time. Okay, now, so you do not have the study guide, right? And do you know that for those who are taking ICS, how many of you? The class time is tentatively Thursday. You can see not your SIS. What time until what time? Until 5:30, right? Because I can see got 3 students. I don't know what is the student name put. I can see like 3. I don't know why I only have 3 students. They have not finished. I think so it will be next Thursday onwards, right? 2:30 or 5:30, right? So I will see your 2:30 after the FR class, and then we will see whether we can do it like earlier, like 1 to 4 or whatever is it. So we will utilize some of the time when you get your textbook. Not compulsory. You listen. When you get your textbook, study guide is textbook. When you get your study guide, we will fork out some of the time, maybe during that time, or online also can, not compulsory. Highlight together because I've highlighted already, so I can tell you which one is important. You highlight what like that, then can already. Okay. So especially for theory, content, so that it might help you a little bit. Now, so we are now starting module 3 already. Module 3, there are 2 standards roughly. The first part is the newer standard, which is IFRS 15. This is the most boring standard on earth, and if you cannot sleep, you read this standard. So IS 37, the second one, we'll do tomorrow. That one is very easy. Now, when you read your textbook next time, you have to be aware or and or. Here, when you read your study guide, you have to be careful or ALL and OR, because some of the conditions you have to fulfill all, everyone. Some of the condition is you fulfill one of them, then can already. So I was thinking at that time, so I just type it down lah. Otherwise, it is quite difficult. It is very dry and so on. Now, last time we used IAS 18. ACCA, you have to know the history and current one and future one. CPA, we only learn the current one that it is in use. So by the way, last time we used a simpler method, or if you are tackling a small company, you're not doing public listed company and so on, you don't have to do this very complex method. Now this is IFRS 15. All sort of sales and revenue the company earns, we will follow IFRS 15. It is a single comprehensive model. So the name is called revenue from contracts with customer. Contract does not mean that you must have 100 pages of paper. A phone call can be a contract. For example, a bank call you and say, you want to buy insurance or not, then after that you got benefit, and then you say, oh, okay lah, I want to buy contract. Okay, so however, there are some of the business transactions that might have two standards. Then what you will do, you will apply IFRS 15, the last one. So for example, when you have a contract which is a leasing contract, then you will use lease to do whatever you have to do the accounting treatment first. Then the last one, you can use IFRS 15 for executory income. If you don't understand, never mind. If you have one contract, there are many relevant standards in there. You will use your IFRS 15 revenue recognition, the last one. Now, so there are 5 steps. Because all sort of revenue, you will use IFRS 15. Like all sort of fair value, you will use IFRS 13. Okay? So IFRS 15 is a single comprehensive model. It is good and therefore it is here now. So we have 5 steps. Number 1, you identify the contract, you identify the customer. Now, you will learn the definition of customer and the definition of contract in the textbook. So basically, customer is the counterparty. Customer is the counterparty, and you have a contractual relationship with that person. Don't know I should share this with you or not, but anyway, this is the thing lah. So we started with a bit of benefit why IFRS 15 is so good, and also sorry I missed out. There are 5 steps. So we are now looking at step 1, contract and customer. We have to identify contract and customer. So customer is a party in the contract. Okay, normally there is an exchange of goods or service for a consideration. Sometimes it is in money. Maybe you sell something to that person will pay you money. Alright, so that person is your customer. Contract is an agreement between 2 parties or more parties that there is an enforceable right and obligation. It doesn't have to be written. It can be oral, okay like that, or implied also can. So because I told you it's a bit dry, maybe I drop this to you so that you can read a bit of that first lah. So I summarize it here. We have to make sure that these all 4 attributes are fulfilled. You have to make sure this one okay, then only you say we have identified contract with customer. So which 4? All parties, normally it's 2 parties. So both parties approve the contract and commitment to performance obligation. Performance, PO is performance obligation, not PO box. And then we can identify each right and payment to the term. That means if I sold facial product to a customer, the customer has the right to use the facial product and I have the right to receive the payment. And both of us agree on whatever and commit to it. Okay? I commit in my application by delivering my facial product, for example. There is a commercial substance, so it is not a manipulated transaction. And then the collection of consideration is possible. It is probable that I will collect back the money from the customer who owe me money. So if these 4 are fulfilled, then we will say that there is a contract with customer. So, and then after that there is question 1. So question 1 actually, before question 1 we look at this one first. Now, roughly this example is like this. Let's say you are a Uni Razak student, and then 10 years later you become Datin. Alright, so you are an Uni Razak alumni, you are Datin, blah 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 like that. And then you want to contribute back, and then what you want to do, you come to Uni Razak Research Center, and then you say, I want to actually donate or sponsor 1 million ringgit for research purpose. Now, question is, from Uni Razak perspective, there is an agreement because Datin and Uni Razak signed an agreement that Datin said, I want to give 1 million over the 2 years for research purpose. So whether this Datin, the alumni, is a customer or not. So step 1 will apply. Now, the answer is no. That alumni is not the customer. Why? Then you have to support your argument why. However, normally this kind of question are not your extended written response, so you have to answer A, B, C, D multiple choice question. Now, because if this alumni is a customer, there is an expectation. The customer should receive a good or a service by giving money as a consideration. So there is a consideration, but there is no output. So it is just supporting the research center in Uni Razak to do research because that person studied here before. So that person is not asking for some output that benefit that person itself. So that person is not asking for a research conclusion that will help that person to earn money or whatever is it. No. And therefore, this grantor, this alumni is not the customer, and we cannot use IFRS 15. We cannot take this 1 million as revenue. Okay, so this can be considered as other income, but this is a donation like this. Okay, so it is not IFRS 15. It is not our sales or not our revenue. So how about question 3.1? Now, question 3.1. A construction company enters into a 3-year agreement with a property developer for the construction of shopping center. Sometimes when a student read the question, also don't understand what is the meaning. Now, that's why I will write. But if you don't see my explanation, you might not be able to understand. So you have to learn yourself. Now, so what happened here is construction company will build something, right? They will construct shopping center, whatever is it like, building. And then the construction company customer is a developer, property developer. And developer is the one who will actually talk with the public like us to sell their condominium or whatever. So we have Sunway as property developer. Many companies actually. So we have a lot of different types of company. They are property developer, and they are actually entering into agreement with a construction company. The construction company will actually follow the agreement to build whatever they want to build. Okay, so this is actually a seller, this is actually a buyer, this is actually a contract. So we want to see whether step 1 is fulfilled or not, whether there is a contract, whether there is a customer or not. Now, after 12 months, the property developer, that means the customer, experiences very significant financial difficulties and it is unlikely to meet the future commitment. Okay, now, no longer probable to receive the payment, and therefore the construction company has to continue reassess the 4 attributes to fulfill IFRS 15 step 1. The meaning is, after 12 months, right, you have to stop recognizing revenue anymore. Because we have to make sure, in order to fulfill step 1, we have to make sure both parties agree with the contract and we are committing to the obligation. I will continue building the shopping center, you will continue paying me. So I will have the right to sell the shopping center as a developer, you will have the right as a developer to sell the shopping center, and I as the construction company, I will receive the payment as per term, and then collection of consideration is possible or probable. But then this is maybe not probable anymore. Collection of consideration is possible. This statement maybe is not probable anymore, and therefore we will stop at that point. And every year you try to reassess to see the financial condition of the developer. Okay. Now, how if sometimes there are multiple contracts? So it is not only one contract, but we have maybe two contracts very near to the first contract, for example. So let's say I enter a contract with a customer to sell 100 units of product within this year. But then 1 month later, the customer say, hey, your product very good, a lot of people want to buy. So can we draw another contract for extra 200 units of your product, but at a discounted price? That means we have two contracts already, multiple contracts in a very near period of time. So to do our account, right, can we just one shot combine them? And what are we supposed to do? Alright, now we can actually combine them if one of the following is met. One of means one of, not all. Alright, either one. So if it is with a single objective, the same objective, one objective only, okay. If the consideration to be paid in contract A depends on the price of contract B, then okay. If there is only one performance obligation, then okay. However, if it is materially different in our accounting treatment, then we don't combine them. So just like I said PO, right? PO refers to performance obligation. Now, for some students who studied module 1 already, maybe you might be confused a little bit, because we say in conceptual framework for the liability element is a present obligation, right? Present obligation, and then this one is performance obligation, right? In the past, some students actually mix up, Actually, these two are different things. Liability, present obligation means at the present moment, I'm obliged to pay back to the supplier because the supplier sold me something. That one is called present obligation or liability. Performance obligation is from the perspective of the seller. Okay? If I sign a contract with you already, I'm obliged to give you the cleaning service for the next 12 months. This is called performance obligation. I'm obliged to perform some service or perform the delivery of goods. That's called performance obligation. Performance obligation is for revenue recognition. Present obligation is for liability. Different. So roughly it's like this. There's a duty. So you have some definition, some boring stuff to remember. So whatever is it, I wrote it over here. I wrote it over here. If you have a multiple contract, very near timing, okay? So create about the same time, like 1 month, 15 days or whatever. Either, when you see either, I normally write all or either. All means all. All. Either means anyone. So we can combine if we have about 2-3 contracts created at the same time, either achieving one of these single objective, or they are interdependent, or there is only one single performance obligation. Okay? But if it is materially different, then we don't combine. This one is another block. Now, so this is called combination of multiple contract. How if we have modification? So if you have a contract and your original contract has to be modified, then what are you going to do? This one you just take it as a concept because it is a bit difficult. Now, you have one contract, you sign the contract already, and then 5 days later, that customer say, our manager came back already, then the manager say, you can increase the quantity or not, or you can minus the price by 5% or not, and so on. So the contract has already been signed by the purchase manager and yourself, but then suddenly you say, can change or not. So this one is contract modification. So when you want to modify a contract, and what are you supposed to do? So you want to see whether the modification is considered as a separate contract, okay, or you have to combine it, not accounted for a separate contract. So we will have some of the keywords that we have to understand. For example, whether it is distinct or whether there is a standalone selling price. Oh yeah, I forgot. This one you study in FAR 2. You remember not? You study in FAR 2, one of the topic, and you can look back your FAR 2 content maybe. So I wrote it here. This is the summary. Now, when you have a modification, maybe you change in the scope, the specification, or the quantity, and then maybe you change the selling price with some discount or whatever. After you sign the contract, so we have to ask ourselves whether it is a separate contract or whether it is not a separate contract. If it is a separate contract, I write and, right? And means this and this must be fulfilled, then only it is a separate contract. So you have to make sure that it is distinct, the product is distinct. Distinct is like mutual exclusive. It is different from one another. It is not interdependent. That's called distinct. Two different things. And then there is a standalone selling price. So the thing can be sold alone to somebody else. If these two are fulfilled, then we say this is a separate contract. Now, if it is a separate contract, what are we going to do? We will recognize the revenue separately for the original contract that's been signed and the so-called new contract that has been changed in scope or amount because it has been modified if it is a separate contract. And the example is in 3.3. Now, if it is not a separate contract, either because it is not distinct or it is distinct but no standalone selling price, it cannot be sold alone, then it depends which one. If it is distinct but there is no standalone selling price, then we will use prospective adjustment. The new one will replace the old contract. If it is not distinct but with standalone selling price, then the new is a part of the old. You will do retrospective adjustment one shot. If it is combination, then you have to do combine. Now this one, you will not have to do any exercises. Now, assuming that you don't understand what I said totally, we will look at example 3.3. Okay, so we will see example 3.3 and try to understand the concept of contract modification. So let's see. Now, this is an example. A company promises to sell 100 widgets to a customer over 12 months for a transaction price of $8,000. Now, IFRS 15 definitely is for the seller, right? Because you want to recognize a revenue, right? So your seller, you recognize the revenue lah. So we are now doing account for this company. We want to sell 100 units. Total is 8,000. This total 8,000, we name it as total transaction price. This is step 3 actually. Later, maybe tomorrow we'll learn it. So every unit is equal to $80 lah, because $8,000 total divided by 100 units is equal to 80 per unit. So the customer will obtain control when they receive the delivery of the widgets. Okay, so we are going to send slowly over the 12 months time. In our agreement, it's like that lah. So after 6 months, and therefore this is not multiple contract, it's not nearing to the time. After 6 months, we have already delivered 45 widgets out of 100 widgets. That means how many left that we have not delivered? 55. Still got 55 we have not delivered. Okay, we have not delivered. But then our customer actually requested this half year later. So we have to modify our contract. We have to see, we modify it like separate it or we combine it. Okay. Now, the customer say they want additional 40 widgets. Now we know that we have 55 left, right? Because 100 only. So 55 we have not delivered. They want additional 40. Okay. Not only on top of the 55, they want additional 40 units more at an additional price of $3,000. $3,000 divided by 40 is 75. That means they are asking for discount. Because they say, okay, my contract is 100, right? So 80 per unit. So now I purchase extra 40. So can you give me a $5 discount or not? So this extra 40 is 75 lah. The 55 that you have not delivered to me, it will be 80 lah. Something like that. Okay? But from our perspective, how are we going to do our count now? So the contract is modified half a year later because there is a change of scope and price. The two questions we have to ask ourselves is whether these additional things are distinct and whether they have their stand-alone selling price. So there are two things that we have to ask ourselves. So now, the additional widgets, they are distinct because you can sell them separately. They are separate from each other. They are independent from each other. Okay, so they are distinct. Number two, they reflect stand-alone selling price. They have their own price to be sold, and therefore these two are fulfilled. So if these two are fulfilled, just now we say, then we will take this as a separate contract over here. Then we will. These two are fulfilled, then we will take it as a separate contract. If we take it as a separate contract, then we will recognize the revenue separately for the original one, the 55 that's not sold at $80, and then a new one at $75. So, yeah. So how are we going to do our account? Now, if I draw this, if you are blur, you see this timeline. Throughout the first 6 months, out of 100 units in the contract that we say we have to deliver, we deliver 45 already. So 45 is sold already. So we still have 55 unsold, and we will do it like next 12 months lah. So at this point, we modify our contract 40 more, and it is 75 per unit for that 40 additional units. So if it is considered as a separate contract, what we will do in the first 6 months, what we will do in the next 6 months is like this. We still have 55 units from the original contract that we have not sold, right? So the 55 units from the original contract, we will calculate based on $80, the O1, as our revenue. So 55 times 80 is 4,004 lah. So let's say we receive money, I just simply write or debtors also never mind. So we receive money, so 4,004 lah. So for the additional widgets which are distinct and with a standalone selling price, we will recognize separately with the new price. So the additional 40 more, you multiply with $75. Cannot see my mouse. Then you will 40 more times $75, you get 3,000. So that's called separate contract. If your contract modification fulfilled distinct and standalone selling price, then you will do like this separately. You recognize your revenue, the original price, the new price macam tu. So this one I think popular question also. A lot of students say they got all these questions. So how if it is not a separate contract? We see we continue with B. So this A, we finished the story already. Now, so for scenario B, so half a year later, our customer received 45 already, left 55 units. Then half a year later, they say, oh, I want additional 40 units of widgets. And we agree with a reduced price of $70 per widget for all the undelivered unit. That means the 55 out of the 100 from the original contract and also the 40 additional one, we will pay, the customer will pay us based on $70. So this is in the position whereby we are at the weaker position, the customer is at a stronger position, or we want to motivate the customer to buy more from us next time. So we say, okay lah, for all the ones that we have not delivered to you, one shot we give you $70, never mind, it's okay, like that. Okay, so this modification, is it considered as a separate contract? So you have to ask yourself two questions, whether they are distinct or not, and whether they are having stand-alone selling price or not. Okay, now the first thing is, the widgets will have, they are distinct, because the 55 one that has not been delivered and also the 40 strong one that has not been delivered, they can be sold separately. Okay, they are separated from each other, so they are distinct. However, the one I colored here, however, the $70 per widget for the additional widget does not reflect the stand-alone selling price of the additional 40 widgets, which is supposed to be 80 per widget. So it does not reflect their stand-alone selling price, and therefore it does not fulfill both at the same time. So right, what we will do is, at least we know it is not a separate contract, and wait, If it is over here, if it is not a separate contract, then you look at this. It is distinct, but no standalone selling price. Okay, it is lumped with the old one altogether at $70. And therefore, we will do prospective adjustment. The new one replace the old one. What does it mean? The easiest one is prospective adjustment, and you only have this as your exercises. Calculation. No calculation for retrospective. So what will we do is, you will do like this. Okay, the same timeline, and then the difference is here. We want 40 more, and the 55 that undelivered, right, with the 40 more, right, all will be at $70. This is the difference. So $70 for the additional 40, and also the remaining 55 from the original or from the initial contract. However, how are we going to do our accounting treatment is like this. The new one replace the old one. The new one replace the old one, the meaning is the new price is $70, will replace the old price. So the original 55 undelivered and the new additional 40 altogether is 95 units. One shot you multiply $70 per unit because there's no standalone price. You cannot split it, average is how much like that, you cannot split it, no standalone price. So you do one shot like this, and then you will get the sales 6650. And you don't have to go back to last year or whatever. If there is a last year in your agreement, you don't have to do retrospective adjustment. So you just do one shot now based on the latest modified contract price, new price, $70 price, and adjust it prospectively. So if you forgot, prospective adjustment means you adjust it now and maybe future. Retrospective adjustment means you adjust it from last time onwards once you started that thing. Okay. I will try to finish, okay lah. Your class is 12:30, is it? Oh, okay. So tomorrow also 12:30.
Yeah.
So you want to start earlier or not? 9 o'clock until 11:30. You want to take lunch or not? Or Sergey is going to give you a lunch break. Then every day you all tell me, ready today cannot come lah, this aiyo. Okay. Tomorrow, by hook or by crook, we will finish IFRS 15, step 2 all the way to step 3, and also IAS 37. Why is because next Thursday, we will do ungraded quiz for module 2 and module 3. One shot, because next Thursday only 1 day class, right? So first week not very stressed lah, you listing paper. So I mean my paper also not stressed. I've not started preparing also ICS. It's okay, so you have to console me. It's okay, slowly.
First week is okay.
I'm not prepared also. So maybe next Thursday we do ungraded module 2, module 3. Although ungraded, you try to do it like properly. And then once your textbook arrives, then maybe we can do the highlight together. Or you want to do together, you want to do yourself also can. Or pass around the book also can, up to you. So next Thursday after our quiz 2, quiz 3, then we will start our module 4 lah, if possible, because I will also explain to you why the answer is correct or wrong for these 2 modules. Okay, so you make sure you really study about it. So you don't do your indexing yet, you cannot do your indexing yet because you have a textbook. And I foresee that your textbook maybe would arrive 2-3 weeks later. Because the payment has not been made today also. And then Aiman made payment already, and then he waited about half a month. So I calculate like that, I think it's about 3 weeks later. So might as well you just spend a lot of time doing your exercises, do whatever, then indexing later. Okay. So maybe I'm not attendance first, wait. Yeah, because I saw 3 students only. I cannot see the student name, but I saw like 2, 3 only. I saw like, just now I also saw like total active. I think not yet. Okay. Afiq, Aiman, Farah, Fatin, Isma, Karya, Mus, Shafika not here. Atila, Atira, Dalila, Kalish. I finally remember your name already. Rina, Aida, Ainina, Aulia, Laila not here. Rida, Aisha, Shaswani, and Mimi. Okay lah. So I see you tomorrow. Tomorrow what time? Can we do like 9 o'clock tomorrow? No? 9 o'clock. I see you tomorrow 9 o'clock. So no matter how we finish, all of the 3 lah. Okay, bye bye everyone. All the best in your test later on. Huh? Oh yeah, ask one more time. We have one more replacement class. We do a vote lah. Who want to do this Friday? Option A is this Friday. Option B is we discuss next time.
Discuss next time.
Just now already like Friday, right? Okay, so we discuss next time. Better when you get the book first. Huh? Yeah.